Hi everyone, it's Amanda and welcome to another edition of Logo Quick Takes. Today, I want to discuss the investment case for a new entry in portfolios, Intuitive Surgical, symbol ISRG. Robotic surgeries and ISRG leadership is a known story, but the stock is now at a much more reasonable price. We've waited for this opportunity and now it's here. Intuitive stock has had a meaningful pullback in 2026, down roughly 15% year-to-date. The stock recently bounced off support within the long-term channel. Using a wide lens view, the stock has roughly 31% upside just to get back to the long-term linear uptrend. The reasons for the pullback aren't a mystery. They're well understood by the market and already reflected in the multiple in our eyes. Investors have spent this year working through real questions about instrument economics as the company reworks its pricing model, genuine competitive entrants both from established medtech incumbents and a new wave of venture-backed challengers, and a broader medtech valuation reset that's hit even the highest quality names in the group. That combination has driven a meaningful multiple contraction. The stock now trades at a fraction of where it started the year, even as the underlying business has kept growing. For patient investors willing to look past normal business and industry noise, that repricing is arguably the more interesting entry point than the stock offered at its highs. The secular backdrop hasn't changed, and it doesn't need much interpretation. The global population over 65 is expanding faster than at any point in modern history, and older patients disproportionately need the procedures robotic surgery already serves best: cardiac, oncologic, urologic, and general soft tissue surgery. Combine that with a persistent global shortage of surgeons and operating room nursing staff, and hospital systems have a structural reason to keep adopting technology that standardizes technique and lets fewer surgeons safely handle more complex caseloads. Perhaps that's why management has begun creating the new marketing campaign showing real-world stories of ISRG to drive more doctor conversations. Deion Sanders was a key surgery beneficiary recently. We expect to see more of these stories to help build the brand, similar to the self-diagnosing thems used by pharma commercials. Something important to discuss: what's early here is penetration, not the technology. Intuitive has commercialized Da Vinci since 2000, treated more than 17 million patients, and installed over 11,000 systems worldwide. This is a mature, proven platform, not an unproven bet. What remains genuinely early is how much of the eligible surgical market has actually converted. The large majority of soft tissue procedures globally are still done manually or laparoscopically, with robotic procedure growth still running near a high teens compound rate. The leadership position is structural, not just a market share statistic. Roughly 80% global share, built on a razor and blade model where instruments and service, not system sales, now drive the large majority of revenue. Hospitals that adopt Da Vinci train surgeons on it and rarely switch, which is why well-funded competitors remain years behind on approved indications and installed base, even where they've closed the technology gap on paper. And there are real, active levers pushing procedure growth higher right now, not just a demographic tailwind sitting in the background. Force feedback instruments, a genuine clinical upgrade, have been supply constrained since approval, and that constraint has just been resolved, clearing the way for adoption to climb as the newest generation system's installed base keeps expanding. The company is also deliberately extending instrument life specifically to lower the cost per use for hospitals, to pull more cost-sensitive procedures onto the robotic platform instead of laparoscopic alternatives. International procedure growth is now outpacing the U.S., meaning geographic expansion is showing up in reported results, not just guidance language. And a newer endoluminal platform is opening an entirely separate procedure category in lung diagnostics, extending the growth ceiling beyond core surgery altogether. The pullback reflects real risks that haven't disappeared: reworked instrument economics, credible new competition, and a stock that's already repriced sharply once this year. But the combination of a proven, dominant platform, a still early penetration curve, and several concrete growth levers turning on at the same time is what makes this look like a more reasonable entry for investors willing to hold through the noise rather than a value trap dressed up as one. That's it for now. Thanks for listening.